Hi, this is Chiro, and today I'm going to be talking about warrant arbitrage on Hyliion, ticker SHLL, in September 2020. If you're not familiar with Hyliion, you might want to check out my video on them from August. As a quick disclaimer, I am not a qualified investment advisor, and my goal with this video is to provide context about what's going on, not to provide investment advice. I have investments in this merger, but I am not sponsored or otherwise affiliated with Hyliion or Tortoise Acquisition Corp., which I'll also refer to by their ticker, SHELL. To begin with some background, warrants give you the right but not the obligation to buy shares of a company at a set price, which to you as the investor basically works like a call option. This price, $11.50 in our case, represents money that will go towards funding the company. Assuming the merger between Hyliion and Shell goes through, all the shares and warrants we discussed today will trade on the New York Stock Exchange under the ticker HYLN. For now, only shares and warrants of Tortoise Acquisition Corporation are publicly tradable under the ticker SHLL and SHLL.WS, respectively. If and when the merger happens, shares of Shell will become Hyliion shares at a 1-to-1 ratio, and Shell warrants will become redeemable for shares of Hyliion at a cost of $11.50 per share. There are also units that trade under SHLL.U that represent one share and half a warrant, but there's nothing special about units for us to cover today. The merger will be voted on during a stockholder meeting scheduled for the 28th of September, and warrants will be exercisable as early as 30 days from the merger, pending SEC approval. I've highly abbreviated the information about the merger and conditions for warrants to be exercisable in this video, but full details of these conditions can be found in the SEC filings linked in the video description. So let's move on to the idea of warrant arbitrage. At the time of recording, shares of Shell are trading at about $50, so buying Shell would be like buying shares of Hyliion at $50 per share. On the other hand, warrants cost about $20. Shell warrants will be exercisable for shares of Hyliion at a cost of $11.50, so buying a warrant is like buying a share of Hyliion for $31.50. Wow! The share and warrant prices will change from day to day, but the discrepancy in prices will likely exist up until the warrants are officially exercisable. The most straightforward way to take advantage of this arbitrage is to sell shares of Shell and buy the warrants. If you don't already own shares of Shell, this will require you to short sell shares of Shell, or in other words, borrow shares you don't own to sell, which you'll then have to buy back to return later. Leading up to Nikola Corporation's merger, borrow fees were as high as $1 per share per day, so this can be a huge expense. The shares may also get bought back from you at any time, which will require you to have the cash on hand and can incur unexpected losses. The worst case scenario for this is probably the shares skyrocketing in value, your shares getting bought back, followed by the share price crashing before you have a chance to re-establish your position. The best case scenario is you smash the like and subscribe buttons on this video. The second best case scenario is your shares don't get bought back, you exercise your warrants turn into shares, and you officially earn the warrant arbitrage, minus any fees. It is also possible to short the shares by selling calls, but note that deep in the money calls will basically get exercised immediately, even if they don't expire for a few months. This is due to the high borrow fees, since people would rather own shares to get paid the borrow fee than the call. In the end, selling naked calls can easily expose you to the same risks as simply short selling the shares. Alternately, if your call doesn't get exercised, you keep the premium, but you're not really taking advantage of the arbitrage and will still lose money if the shares and warrants crash in value. Note that the risks I talked about in this video aren't easily quantifiable and vary depending on things like your broker, whether you get assigned, and for all I know, your zodiac sign. These risks should be thoroughly researched and understood before attempting any of these strategies, and bear in mind that if you employ these strategies, you'll basically be carrying these risks until at least 30 days after the merger is complete. In the end, I find that these strategies expose you to a lot of short-term risk for what is essentially a $20 per share payoff. Personally, I believe in the long-term success of the company, and my current strategy has been to buy warrants and sell cash-covered puts that expire well after the warrants are expected to be exercisable. Once the warrants are exercisable, the share price and equivalent price of the warrants will quickly balance out, which likely means the shares will drop in price and warrants will rise upon the announcement. A lot can happen between now and the warrants being exercisable though, so we'll have to wait and see. And that's that. I'd love to know your thoughts about this arbitrage opportunity in the comments down below. I hope you found this interesting and learned something from it. If so, please leave a like and consider subscribing to see more future content. Until next time, have a great day.